Good afternoon. Welcome back to our afternoon session of the March 12, 2026 Investor Advisory Committee meeting. Adam, do we need to note if any IC members have joined or departed as we return to the public session?
Nancy Lamond has departed.
Okay. Nancy Lamond has departed. We'll begin our session this afternoon. It's going to run from 2:30 to 5 p.m. Our afternoon session begins with our second panel, Fund Proxy Voting, Challenges, Costs, and Pathways to Modernization, moderated by Rodney Comegis and Paul Roy, followed by discussion of our potential committee recommendation. Rodney and Paul, I turn it over to you.
Thank you, Brian, and thank you to the commissioners for your words this morning, the fellow IAC members for your participation, and a great discussion this morning. And a special welcome to our panelists on the topic of mutual fund proxies, and specifically open-ended mutual fund proxies. Today's panel is going to examine open-end proxy fund voting framework, which is governed primarily by the Investment Act of 1940 and its rules. The framework was intended to protect investors by requiring shareholder approval for certain significant matters, including advisory contracts, director elections, changes to fundamental investment policies, and many fund mergers. Unlike operating companies, open-end mutual funds are not required to hold an annual shareholder meeting. As a result, proxy voting generally occurs only when there is a specific approval required, often under tight time constraints with meaningful logistical and cost considerations. The proxy system was developed under an earlier environment, one that relied on paper mail, landline telephones, and often broker discretionary voting, mechanisms that historically supported shareholder participation and reaching quorum, and therefore the proper input for mutual fund shareholders. Got to turn your paper to the right page, otherwise it goes out of order. Over time, there's been a big change. A lot more investors are invested in mutual funds. And then proxy solicitations have evolved into electronic and digital campaigns. Funds continue in that environment to face challenges reaching quorum with increased costs. My own firm's last proxy campaign cost $100 million to reach all of our investors. There's practical challenges. Large, retail-heavy, dispersed shareholders have historically very low participation rates. There's high levels of intermediation that limit direct communication with shareholders. There's regulatory constraints on outreach methods, including the Telephone Consumer Protection Act, which makes it difficult to contact investors. And there's declining effectiveness in our solicitation tools and increased investor caution regarding fraud and phishing. The reduction of broker discretionary voting, which previously contributed to achieving quorum. As a result, we're having trouble getting a quorum for mutual funds and getting the proper input. Yet we still want to protect investors and make sure they have a voice in the important matters that are a part of their fund. That's what the panel is going to explore. What are the challenges, and then what can we do about it to make it better while still protecting investors? We have 5 distinguished guests. We're going to introduce them. Paul's going to take the lead on the first, and then we'll go one by one. We're going to ask that we save questions till we finish hearing the opening remarks from all 5 panelists.
Thank you, Rodney, and welcome all to our discussion. We're fortunate this afternoon that we have a really distinguished, experienced panel to discuss the fund proxy framework and the problems and issues that Rodney outlined. So it's my pleasure to introduce our panelists. First, I start with Adam Hinkle. Adam is Assistant General Counsel for U.S. Product Strategy and Governance at Invesco, where he advises on legal and regulatory matters regarding registered investment products, including mutual funds and ETFs. From 2020 to 2024, he served as head of legal for U.S. ETFs, and before that, he had an earlier role as senior counsel with the firm. Adam's work focuses on product development, government structures, board matters, and regulatory compliance, which provides him hands-on experience with the proxy voting requirements applicable to modern fund complexes. He regularly advises on issues involving fund reorganizations, advisory agreements, disclosures, and shareholder approvals. Prior to joining Investigo, Adam worked at U.S. Bancorp Fund Services and at the law firm Chapman and Cutler, where he developed deep experience in investment management law and fund operations. Next, again, we're fortunate to have Terry Nielsen. Terry's the president and CEO and secretary of Hennessy Advisors, Inc., where she serves on the firm's board of directors and is executive vice president and treasurer of the Hennessy Mutual Funds. She was a founding executive of the firm when she joined the firm in 1989 and has played a central role in building the organization from its inception alongside the founder, Neil Hennessy. She has nearly 4 decades of experience in the securities industry. She's been deeply involved in all aspects of fund operations, governance, and regulatory compliance. Her career has spanned periods of significant change in the asset management industry, giving her a practical, operational perspective on how regulatory requirements, particularly those governing fund proxy voting, affect mutual fund complexes and their shareholders. Next, we have Corey Freyer. Corey is Director of Investor Protection at the Consumer Federation of America, where he leads the organization's work protecting retail investors, safeguarding retirement assets, and overseeing the regulation of America's capital markets. In this role, he focuses on ensuring that regulatory frameworks promote fair outcomes for individual investors and maintain market integrity. Corey has over 20 years of experience in financial policy across Congress and the SEC. Most recently, he served as senior advisor to SEC Chairman Gary Gensler on crypto asset markets and financial stability, and also acted as the SEC's deputy to the Financial Stability Oversight Council. So his work at the SEC has spanned investor protection, systemic risk, and the application of securities laws to emerging financial technologies. Before joining the SEC, Corey spent 15 years in Congress working for Representative Brad Miller and on the House Financial Services Committee for Representative Maxine Waters and on the Senate Banking, House, and Urban Affairs Committee for Senator Sherrod Brown. In these roles, he advised on a broad range of financial regulatory issues, including consumer protection, bank regulation, and market oversight. And then we have Paul Salupica. Paul is General Counsel of the Investment Company Institute, which is the trade association for the investment company industry. He's been General Counsel since June of 2024. As the Chief Legal Officer of the ICI, he represents the organization on legal and regulatory matters and leads a highly experienced legal team covering securities regulation, investment company law, ERISA, fund taxation, and related disciplines. He has more than 30 years' experience in securities law and financial regulation across both the public and private sectors. From 2018 to 2021, he's no stranger to this building, as he was Deputy Director and Chief Counsel of the Division of Investment Management, an office responsible for responding to requests for legal and policy guidance, reviewing applications for exemptive relief, and engaging with domestic and international regulators on asset management issues. Prior to his SEC service, he had senior legal leadership roles at several major financial institutions, including serving as Executive Vice President and Deputy General Counsel at PIMCO, General Counsel for Securities Law at Teachers Insurance and Annuity Association, TIAA, and as Chief Counsel for the Americas at MetLife. So accordingly, he has extensive experience dealing with mutual funds, investment products, insurance, and global asset management. And then finally, we have Robert Robertson. Robert is a partner in the Deckard Law Firm, where he focuses on investment management, securities regulation, and SEC enforcement and examinations. Again, he also has 30 years of experience advising asset managers, fund boards, and financial institutions on complex regulatory and governance matters. Rob began his career at the U.S. Securities and Exchange Commission here. He held a variety of senior policy roles. He also served in the White House counsel's office. His practice spans regulatory compliance, enforcement defense, and strategic counseling for mutual funds and investment advisory clients. He also is a lecturer at the USC Gold School of Law, where he teaches securities regulation, reflecting his longstanding engagement with regulatory policy and education. And I also note that Rob has a treatise on fund governance, so very appropriate to have Rob here on our panel. So with that, we're going to start off with Robert, and he's going to set the groundwork for us and lay out the regulatory requirements that apply to the mutual fund and ETF proxy voting framework. Robert?
Thank you, Paul. Sometimes I speak as a practitioner and sometimes as an academic. Initially, I'll speak as a practitioner, so I'll keep the academic stuff off to the side. So shareholder approval and quorum requirements may be governed by a fund's governing organizational documents, state law, or the 40 Act. For many fund actions that require shareholder approval, they must meet a 1940 Act majority standard, and that's in Section 2A42 of the Investment Company Act. And it's a incredibly complicated standard, and there are two ways to meet that burden. But in virtually all cases, the standard is you have to have 67% of the vote in person or by proxy when at least 50% of your outstanding shares are present at the meeting. So you have to have the 50% standard met, and then 67% of those have to approve the proposal. My comments are going to, when it comes to what actions require shareholder approval, my comments are going to focus primarily on open-end funds, and that's mutual funds and ETFs. Closed-end funds are really a different animal. So, fund directors. In practice, the initial board of directors or trustees, I'll use the term directors, are appointed by the sole initial trustee. So just one person, because there are no outstanding shareholders, no public shareholders at that time. And so you have your initial board. It could be 5, 7, 9, whatever that is. There's a provision in the 40 Act that states that at least 2/3 of all directors must be elected by shareholders. So over time, you get new directors, others resign, others retire, whatever the case. But when you start to get down to the 2/3 requirement, then you have to go out and have an actual shareholder meeting. When it comes to a quorum for directors, it might be 30%, 33 1/3%, 50%. It depends on state law and the organizational documents. Other items where shareholder approval is required would be amendments to a fund's governing documents. Also, as was mentioned earlier, investment advisory agreements and material amendments to investment advisory agreements. And in our world, that generally would mean a fee increase. This also would apply to sub-advisory contracts, although many fund groups, most fund groups that have sub-advised funds have an exemptive order to allow the board to make material changes. Also, the principal underwriting agreement must be approved by fund shareholders, and also the 12B1 plan, especially material increases in a 12B1 fee. Lastly, fundamental investment policies, and there's a whole list under the 40 Act of what needs to be approved and what amendments need to be approved by shareholders. And I forgot to mention unaffiliated fund mergers. The target fund shareholders would approve that particular transaction, and certain affiliated fund mergers that don't meet particular requirements. Now, I'd like to compare that to an operating company. For an operating company that's publicly traded, they would have to annually elect directors. They would vote on executive compensation, equity compensation plans, fundamental corporate changes, and certain issuance of stock. The principles behind what an operating company shareholders approve and what a fund shareholders approve are completely different. For listed companies, the central governance question is one of principle and agency. Shareholder voting on directors, compensation, major transactions is really an attempt to constrain the self-interested behavior of managers and directors. It's about agency. And then there are also shareholder approval requirements that are related to dilution. For fund votes, there's also the agency principle, which is really a carryover from corporate law, but something completely different, which is investor and fiduciary principles. For funds and ETFs, investors are contributing capital to a managed pool, and the fund's manager controls the strategy and operations. The risk for funds is not management entrenchment, but rather self-dealing and style drift. Also, there's the concept of a bargain for product principle. A mutual fund investor buys a particular product, a fund with a particular investment objective, fundamental policies. It's really about getting the bargain that you purchased. You know, not unlike you don't want to buy a Volvo and go to the dealer and find out that you bought a Pinto, which was my first car. So what I want to leave you with is that the legal framework for operating companies and investment companies is different and should be regulated differently. In addition, most of the shareholder voting requirements under the 40 Act do require you to have a quorum of at least 50%. And lastly, all the items that I talked about that would require a shareholder vote make perfect sense in theory.
Speaking about practice and theory, we wanted to hear next from Terry Nelson about what the actual experience has been of meeting these requirements and getting the votes necessary or to either approve or disapprove something. Terry, what is at Hennessy? What have you guys experienced, and what can you tell us?
Sure. First, I want to thank you all for having me here today and for discussing this really important topic. It's interesting because Adam and I come from like two very distinct worlds. He's Invesco, and he sneezes the amount that we have under management every day. You know, I've spent the last 35 years plus, as Paul mentioned, in the day-to-day operations of running a small publicly held asset manager, so both an operator and we run mutual funds and an ETF. And we have 19 employees, so it's a little different than his world, but I think it's great that you're going to hear from both of us because there's so many similarities. It's very diverse, but there's so many similarities in our story. At Hennessy Advisors, we manage 16 mutual funds and an ETF with about $4.2 billion in assets under management. We are retail focused. Can you guys hear me okay? And we are shareholder facing. At our firm, we actually answer the phone. We have no voicemail. All of us are trained to speak to our investors. And we do that on a daily basis. When I discuss proxy reform, I'm not speaking from theory, I'm speaking from real-life experience. We do this as a team. We've completed 12 acquisitions involving 33 funds over the course of my career at NSE. And for the first time in our history, we had a proxy campaign fail. In December of 2025, we could not reach quorum after 4 adjournments. We've never experienced that, even though 96% of the shareholders who voted supported the proposal. The transaction failed not because investors objected, but because we could not reach enough of them to vote. It was very difficult. Before we walk through why this happens, I want to be clear that we believe practical solutions exist, that the SEC has tools to act in the form of no action relief, exemptive relief, staff guidance, and rulemaking. And I know we're going to discuss possible solutions, but first I'd really like to share our experience on why proxy problems are difficult to solve. When funds require a shareholder approval, investors receive proxy materials explaining the proposal and how to vote, whether that's by phone, by the mail, or online. Across all of our acquisitions, whenever I spoke or we as a team spoke directly with shareholders, which we did a lot of, during a campaign, the response was almost always universally the same. They really didn't understand why they were being asked to vote. In our world, shareholders may hold our funds, and it's an ICI, it's in all of their data, 3.5 to 4 years. They may never even receive a proxy from us during that time. And then when they do receive one, they're very confused because we don't have a shareholder meeting anymore, right, like a public company. So they rarely connect the proxy materials they've received to the investment in the fund. They just don't connect that. There's not connectivity there. There are some positive interactions, too, once you could reach an investor, but by and large, those interactions are pretty negative, and I know Adam's going to speak to that. They assume the information they received was junk mail, or they suspect it's a scam. Many just want you to stop bothering them altogether. Stop mailing me, stop calling me. Please don't overnight mail me anything. They do really think it's scam. And it's not a criticism of the retail investor. That's my bread and butter. It is an example of a system that's currently not designed with the modern investor behavior in mind. A system built for landlines and paper mail, applied to a world of mobile phones, text filters, and crowded inboxes, and opting out. That's what people want to do. They want to opt out. So the structural reality is funds are responsible for obtaining the vote, but legal and operational hurdles often prevent us from reaching the voter. It's hard. And I think there's several factors why funds struggle to obtain quorum. One factor is it is a retail-heavy shareholder base. They hold approximately 88% of fund assets, probably 94% of long-term fund assets, and that's who we are at Hennessy. Yet retail proxy participation remains 28 to 30%. When quorum requires participation from more than 50% or 50% of outstanding shares, you can see how that math becomes extremely difficult. And another factor is that funds are predominantly held at third-party platforms. So at Hennessy, we're about 12% held direct. So the other 88% is held at Schwab and Fidelity and Morgan Stanley and other omnibus structures or retirement accounts. OBOs, or objecting beneficial owner rules under the SEC regulations, prohibit us, funds, from contacting shareholders who have instructed intermediaries not to disclose their identities. Communication has to go through those multiple intermediary layers, adding cost, delay, and some friction at every step. I've talked to shareholders who say, I'm at Raymond James, why, leave me alone. But you hold our fund, It's one more layer of difficult explanation. Regulations can also suppress participation. And as I mentioned, OBO rules prohibit direct contact. But as Rodney mentioned, you have the Telephone Consumer Protection Act, which restricts calling or texting cell phones. If you're lucky enough to have access to a cell phone, our experience is mobile users are the first ones who routinely don't answer your calls. And especially now with the new stuff where who are you? You're like, I'm your proxy person. It's me, Mom. I mean, that's what you kind of want to get to that point because that's what it feels like. I think the major hurdle really is investor skepticism. And investor skepticism is no different than just a consumer skepticism. We have all been taught, don't click on that, don't answer that, screen that, throw that mail away, shred this. it's kind of the world, and we need to catch up so we can protect our investors better, right? They treat any kind of unsolicited outreach as junk mail, spam, phishing, fraud attempts. And proxy materials are also very technically dense, right? They're thick, and they required a lot of legal disclosures that were never really designed for retail readability. I think summarizing we summarized the proxy and did a great job. The SEC did a great job on that. And the summary prospectus, I mean, we have not summarized the proxy. We summarized the prospectus, and I think that made a big difference for our investors. The TSRs are making a great example of modernization that worked, and I think we need to do the same for proxies. Simplify them, allow us to have links, allow us to really be able to make it the kind of communication we're used to. I walked through the whole ExxonMobil thing. I even signed up. I got some Exxon shares just to sign up to try the whole thing. It's pretty slick, and it really does help educate. Now, it is very different to be the owner of a stock versus a fund because, again, it's a pooled asset. They really do look at us like, hey, you're my guy. You're investing my money. I don't want to vote. That's a hurdle. And there's shareholder fatigue from all the multiple outreach, which can damage your brand, whether you're Hennessy or Invesco, and lead to redemptions. And that's not fair when we're trying to do the best thing we can. In most cases, again, 92 to 96% are always in agreement, and it's that small portion you can't reach that you're alienating, and that's really hard. There's a data point from Broadridge Proxy Plus from their 2025 publication that says retail investor voting participation has declined to 28% of shares owned in 2025. It's the lowest level in 9 years, and institutional participation also fell. The trends are just moving in the wrong direction. Despite advances in digital technology and notice and access delivery, we're still seeing this go out the door. And what I feel like sometimes in our business, and even though we talk about it a lot, even though we're a small shop, we're so lucky to be in the most regulated securities industry in the world because you are really providing safety to your investors. But like most everything in our lives, we do something if the user experience is pleasant. And right now, it's pretty evident that the proxy experience for our investors is not. And so that also turns people away. An unforeseen consequence of these hurdles is that fund companies avoid beneficial changes and they feel stuck. The cost and uncertainty of proxy process doesn't just burden funds that run campaigns. It shapes decisions long before a campaign is ever launched. 77%, ICI did a survey in 2019, 77% of respondents said they would consider changing at least one fundamental policy if they could do so with board approval and advance notice. 40% said the proxy process has impeded adding new board members. That's terrible. 36 said proxy costs had led them to liquidate funds rather than pursue shareholder-approved mergers. And the reality for smaller complexes is, for a firm like ours, it's more than just statistics. When we evaluate whether to pursue a fund acquisition or other fundamental changes, the proxy campaign cost is a real line item for us. It's part of our decision making. In some cases, the rational financial decision is not to pursue a transaction or other types of good fundamental changes, not because it wouldn't benefit shareholders, but because the probability of quorum failure, including the cost, makes the outcome too risky. And it disproportionately penalizes smaller retail-focused complexes because that's where the burden is the heaviest. Relative to scale, and our internal staff has to absorb a lot of that operational load. So we're right in that flux where we're making decisions that should benefit our shareholders because we can't get there, we can't get the vote. How should reform happen? I'm going to keep my solutions very high level since I'm not an attorney, and we have a few sitting here who will have better answers. The path matters, and the good news is that not everything requires rulemaking. The SEC has multiple levers available, and the reforms most needed can be sequenced by what is most achievable. So I think the retail voting programs are fast becoming the anchor. The Exxon No Action Letter established a precedent for issuers. In September of 2025, retail shareholders can opt in to standing voting instructions that allow them to be voted on a standing basis that's revocable at any time, right? They can opt out. Extending this framework to registered funds is a little more nuanced. but it could be really impactful in the near future, right? One thing I wasn't going to talk about, but I thought about when I listened to the tokenization stuff, is that if we are headed there, a lot of these steps will help us be more comfortable with our investors when it's more electronic, when they can have more decision-making on their own, helping them learn about proxy and helping them get there through some of this interaction that is actually positive would really help. Not that I know anything about tokenization, so don't ask me, because it scares me. So I think it's got to be narrowly scoped with routine matters, with carve-outs for non-routine matters, so it can build trust and demonstrate the model works before broader extension. And the right strategy is to start where the SEC can move a little quickly to build momentum and a track record and work deliberately toward the more complex reforms. And I think it demonstrates the SEC's commitment to modernization for proxy. So I think it starts with no action and SEC staff relief, retail voting programs, SVIs for routine matters, echo voting frameworks for targeted quorum guidance. We already use that for fund to funds and some other products, and that used to be used quite more often. And for us, in this last campaign, we got down to needing only like 60,000, 80,000 votes. If we could have had, after 4 times that we adjourned and calling everyone we could call, it would have been great to echo vote that last piece if we could have said to the SEC, look, we have done everything. Can we have a targeted quorum here to get to the end zone, right? Just one more step to help us who really do want to do the best we can for our shareholders. Exemptive relief and staff guidance, so board appointment authority like we do for the auditors, and maybe we can do that for fund directors with that advance notice. And OBO communication flexibility, maybe allowing us to mail direct with some kind of relief there. APA rulemaking, of course, is the next thing, which takes longer, but quorum threshold, modernization, processing fee reform, which that one's very difficult. And again, the proxy disclosure simplification. And if we could summary proxy like we've done with those other products, I think it would make a big difference. And statutory change will take a long time, but that's, changing majority vote thresholds. And I know that's out there a lot, but that's a longer term one. And we're not asking to remove investor protections here. We're asking to modernize the mechanics, fix the plumbing, so those protections are more accessible to investors, and they're meant to serve, that we are meant to serve, and so that scarce shareholder dollars are spent on substance and not on repeated solicitations and not bothering people at dinner on Sunday night when they're with their families. So the last thing I really want to say is when shareholders vote, they say yes, 92 to 96% of the time. The ICI estimates the industry has spent millions on this, right? 675 to 1.14 billion on proxy campaigns since 2020 in different levers. And we're not spending that money because investors disagree. We're spending it because we can't reach them. And we are antagonizing them trying. It's not opposition, it's lack of participation. So I think we can make those protections more meaningful today, especially in light of how funds are owned and investors actually behave. So the solutions, I think, are practical. The legal authority exists, and the data is overwhelming. I think it's really time for some proxy reform.
Thank you, Terry, for your perspective as a smaller fund complex. And now we're going to hear from Adam, who represents a large fund complex at recent experience with the proxy solicitation issue.
Great. Thank you, Paul. And again, thank you all for having us here today for such an important topic. First of all, I'm glad I'm following Terry because I can just say I basically agree with everything that she said. So apologies in advance if you're going to hear things repeated, but I suppose if you have to hear the same information over and over again, you're starting to see a small glimpse as to what it is to be a shareholder during a proxy solicitation. So one thing, so Terry talked a little bit about, I think somewhat glibly, about the size of Hennessy funds as compared to Invesco. And there is a difference there, but I think one thing that is absolutely the same is that we hold our shareholder experience and their outcomes to be the most important thing that we do. I'm very proud of myself, and I'm very proud to work at a place where we consider where we've always heard from our shareholders and our clients that we put them first, that we have good experience with them, good communication lines, good, basically the entire experience from the beginning to the end of being a shareholder. And then we do a proxy. And all of a sudden, we hear the exact opposite. And that's why it's such an important topic. So you may have heard that in the middle to the end of last year, Invesco engaged in a proxy for Invesco QQQ, an ETF with approximately 400 billion assets under management. That proxy lasted from about the mid-July through mid-December, over 5 months. The total shares outstanding of the fund were over 600 million, about 650 million, and we estimated about 5 million investors. It is an incredibly retail product, and so working on it firsthand gave me an interesting perspective that I'd like to share a little bit about what it is to get the vote to make important and meaningful and largely beneficial changes to a fund. First of all, I will note, similar to what Terry said, the votes that came in were overwhelmingly in favor. It's very rarely about that shareholders don't like what you're proposing to do. It's that they just don't want to vote. I will share anecdotally. My sister said to me, I got something in the mail about Invesco QQQ. What is it? I said, please vote. And she said, fine, I will, but only because you're my brother. Otherwise, this would go straight into the trash. Frankly, I don't think that is a surprising reaction from people. And so because it is so difficult to get this quorum, and Terry kind of alluded to this, you end up having to do a lot of tactics which are intended to get to finally reach someone, get someone on the phone, get someone to look at something. We don't typically impersonate your mother, but we come up pretty close to that when we're trying to reach you. The calls during dinner is an unfortunate reality of the process. And as I mentioned before, QQQ is an incredibly retail-oriented product. When we started the process, I mean, you've probably seen some of the ads if you watch sports or whatever. We know that there are people who are, one of their first investments is QQQ just because of the way in which it is a household name. So you might have $2,500 invested in QQQ. We estimated that probably somewhere in the neighborhood of 17 to 18% of the shares outstanding were held by people who held less than $10,000 in the fund. So this is an incredibly retail product. One thing that and I'm going to come back to that in a moment, but one thing that I want to say out at the outset is that my interest and our interest, Invesco's interest in this topic, is not about easing the burden for an investment company to get things done. It's also not necessarily about saving money. It is that other thing that I said right at the outset. For the first time that I'd ever worked, and I've worked at Invesco for over 13 years, for the first time I was hearing complaints, constant complaints. Why am I getting this? Why are you calling me? The complaints going to the intermediaries, the brokers. Why is Invesco reaching out? Are you reaching out? Aren't you my advisor? Shouldn't you be the one handling this? Confusion, all of that. This is really about this. So this is not about the investment companies being able to get what they've done faster or easier. It's about enhancing the shareholder experience. And I understand that these rules and regulations were designed with the idea of ensuring that, hey, you're an investor, your voice will be heard. Well, I'm here to tell you that that proxy was one where we literally wanted the person who had 10 shares to vote. We were reaching out. If ever there was a Your Vote Matters campaign, this was it. And those retail Main Street mom and pop investors hated it the most. They were the ones that you'd think that you don't typically think of like, the ability to vote on a proxy as being the things that you need to protect the large institutional investors. They're sophisticated, they know what's going on, they'll make their determination. You think of them as being principally more for the retail investor. Retail investors hate this. This is good for nobody. The current structure and the current situation is good for nobody. And as I say, it's not about that they didn't like what we were proposing. It was that they just didn't want to be bothered by it. They don't view themselves as, I invest in this fund because I want to have a say in how it's governed. And our proxy, the Q's proxy particularly, was about an advisory agreement, was about electing investors, and also changing the structure from a unit investment trust to an open-end management company. Now, again, imagine your average retail investor wrapping their head around that, and I don't mean that in a derogatory sense whatsoever. It's just a very complicated topic. But even things like diversification, switching diversification from diversified to non-diversified, these are very common reasons why people have proxies. Your average retail investor does not view themselves as needing to have something to say, isn't it your job to manage the fund? Why am I the one managing the fund? So I just want to make clear that we're not looking to disenfranchise investors. We're trying to make good on what we believe investors anticipate and want when they make their investment in the first place. The last thing I'll say on this, the problem thesis is the piece that I care the most about. I think that we're going to hear, and ICI, Paul, and others have a number of ideas as to how this could be improved. And I think that generally there is a lot that can be done. But I think that the last thing I'll say is I'll go back to what also Terry mentioned, which is that besides the fact that this is something that is ultimately structured and designed to just create a terrible experience for your average investor, on top of it, it has a meaningful chilling effect. And I mean that in two ways, and Terry touched on one of them, which is that if you're thinking about doing let's just say, to use my example I already gave of going from diversified to non-diversified, this requires a shareholder vote under the 40 Act. If you're thinking about doing that, the first thing you're going to do is you're going to look at the cost compared to the ultimate benefit. And you might have a new portfolio manager come in and say, listen, I believe that we can generate better returns and better performance if we get a little bit more concentrated in our portfolio, technically this is going to move us from diversified to non-diversified. Should we go and get a shareholder vote? And the answer is going to be no, we're not. It's going to cost too much. That any performance bump that you're going to see will be offset by the cost to the fund for bearing the cost of the proxy, and two, the negative shareholder experience also isn't worth that performance bump. So that's the first piece in why it's chilling. The other way, and this again goes back to who are we protecting here? The other way in which it's chilling is that if you look at if you have a situation, again, like the example that I gave of we're going to determine whether or not to move forward with proxying shareholders, one thing that you'll do is you'll do an assessment of your shareholder base, right? And if your shares are concentrated in large institutional investors, the ones that are easier to reach, you can typically find them because they're not. They may still be objecting beneficial owners, but there are other things, 13Fs or whatever will help you find them to reach out to them to say, hey, please vote on this. And they're likely to vote for, but again, pretty much most of what we've seen in the industry is likely to vote for. If you find a fund if you're looking at your fund and you're like, actually, we think we have maybe 60, 70% being held by large institutions, okay, then let's move forward. Why? Because we can just go to those institutions and get this done and hopefully convince them. Now you're disenfranchising your retail shareholders. It has that further impact on the behavior of investment managers because they're going to say, we're only going to do things that have the high likelihood of success, and that typically means leaving those retail shareholders alone. Maybe they'll vote, maybe they won't. It doesn't matter. We don't need their vote. So I'll bring it back to QQQ. We needed their vote. We actually, when you're doing a solicitation, you'll say we want to reach out to, we can roughly estimate, we want to reach out to people who own 1 million shares or more. 25,000 shares or more. At the end of our campaign, we were reaching out and sending mailings and phone calls to people who had 2 shares or more. Literally everyone. And people were reaching out to us and talking about that the mail that they had received is in inches now, not in numbers of things received. Phone calls. I mean, there's Reddits that you try to stay off of, but I was a
You guys
glutton
have
for
quite a track record.
that I try to stay off of, but glutton for punishment. Talking
Yeah.
about what are they doing? Why are they doing
Is this legal?
Yes, I've heard of stalkers that are less invasive. Every salacious thing you could think of was being said. Again, not my favorite part of where I'm used to hearing, "Wow, you guys do it the right way. It's such a great experience being a shareholder of an Invesco fund." So again, I leave you with that the key thing here is this is a system that disincentivizes action when it could be beneficial to shareholders, or once it is. And again, in the case of the QQQ proxy, we really genuinely felt as though this was something that was in everyone's best interest. And the shareholders that voted, that took the time to read it to understand, overwhelmingly agreed. And at some point, we were at the point where we really felt as though we had an obligation and a duty to the 30% of the shareholders, 40% of the shareholders that have already overwhelmingly voted for this, that we have to see this through to the end. It creates a system that is ultimately not what the average investor wants. And so reforms in this area are not just to benefit in large investment companies that are looking just to make changes, but reforms in this area will ultimately benefit the shareholders as well, which is, I think, the primary mandate for this group.
Thank you, Adam, for sharing your experience and the perspective of the actual investors and how they've experienced the proxy process. Paul, you've heard from two of your members and their experiences. Talk to us about the broad industry and maybe what we can do to improve the process while still, again, making sure shareholders' voices are heard.
Happy to do it. Good afternoon, and thank you for inviting me. Today's panel discussion could not be more timely or welcome from the perspective of the ICI. The ICI is the leading association representing the asset management industry in service of individual investors. And our members have long had experience with the proxy process, and as Terry and Adam described eloquently, in practice, the current system has become increasingly inefficient, costly, and misaligned with shareholder preferences and modern fund ownership arrangements. And I won't dwell on the deficiencies of the current system that they've described so well. But I will note, fund proxy reform has long been a top policy priority for ICI. In 2019, we carefully analyzed the fund proxy system through multiple conversations with members and extensive survey data quantifying the costs and challenges, in particular, of special fund proxy campaigns. Since 2019, has the fund proxy system improved in any way? And short answer, no, it's been getting worse. And so late last year, we conducted another extensive member survey to better understand funds proxy campaign experiences since 2020. And we published the data and our analyses in a white paper earlier this month, and there's a link to the white paper in the agenda for today's session. And we also included several recommendations for improving the fund proxy system. And before I get to the recommendations, I just want to touch briefly on a couple of notable findings from the white paper. So we conservatively estimated that total costs for fund proxy campaigns by mutual funds, ETFs, and closed-end funds since 2020 have ranged from $675 million to $1.14 billion. And we looked more closely at the so-called special proxy campaigns, like the one Adam referenced, and total estimated costs for 362 special campaigns we looked at were between $620 million and $1.06 billion. And 6 campaigns out of that number incurred costs of $25 million or more each, with the most expensive proxy campaign totaling $111 million. Survey respondents strongly indicated that special proxy campaigns have gotten harder and more expensive, many saying significantly so since 2020. And for these categories of proxy campaigns, almost no respondents indicated that their campaigns had become easier or cheaper. As Adam alluded to, a number of special proxy campaigns in recent years have involved funds seeking to change their 1940 Act classifications from diversified to non-diversified. And in many cases, this is not necessarily due to manager desire, but just the growth in the so-called Magnificent Seven stocks. And we analyzed 73 funds that held such campaigns to change from a diversified to non-diversified classification. And the total cost for these non-controversial proposals was $66 million, almost 900 or over 900,000 per fund, with several funds incurring costs in excess of $5 million. Even though voting shareholders strongly favored these proposals by wide margins, with an average of 85% of shares represented voting for these proposals. Notwithstanding the strong percentage in favor of the proposals, more than 1/3 of the proposals required at least one adjournment to meet quorum, and 6 failed for lack of quorum. So decades of experience demonstrate that these trends will not reverse on their own accord. The current system has multiple weak points, as you've heard from the other panelists. Consequently, there's no single fix. However, to improve the fund proxy system, we've recommended that the SEC and its staff explore a number of actions. First, create a new way for a fund to approve items for which the 1940 Act and its rules require a quorum of greater than 50%. For example, coupling a lower quorum requirement, such as 33 1/3%, with a higher affirmative vote requirement, such as 75%. Second, adopt alternatives to shareholder approval, for example, board approval and advance notice to shareholders for certain items, including fundamental policy changes. Third, permit fund boards to appoint a greater number of new independent directors. Fourth, permit funds to adopt retail voting programs similar to that which the SEC staff permitted ExxonMobil Corporation to use to boost retail investor participation in proxy campaigns. Fifth, revise processing fees and shareholder communication provisions to permit funds to select their own vendors and contact shareholders directly. Sixth, reduce the length of proxy statements by allowing greater use of links to improve shareholder engagement. To sum up, as one ICI member succinctly put it in responding to our survey, we're spending a lot of money to irritate our own shareholders. The current fund proxy system is not serving the needs of funds, or more importantly, their shareholders. Our solutions would reconcile those shareholder approval requirements with modern-day realities. More broadly, they would realign the proxy process with its original purpose, protecting shareholders while enabling funds to efficiently serve them. The SEC has congressional authority to implement these changes, and now is the time for action. I look forward to discussing this further.
Thank you, Paul. Appreciate you providing the overview from a broader industry perspective on what's going on in the fund proxy process. Let's turn to Corey. Corey, as an investor advocate, what's your reaction to what's going on in the fund proxy world, and perhaps reacting to some of the possible solutions here to what has been identified as an issue that should be addressed?
Sure. First, thank you to Chair Atkins and the commissioners for having us here today, to the Investor Advisory Committee members, and most importantly for me, to my former colleagues, to the SEC, the career staff, probably the most dedicated and smartest public people I've ever worked with, who have in the last year been asked to do more with a lot less. I look at shareholder democracy in our capital markets a lot like I look at our democracy writ large. You know, in a world where there are lots of competing interests, where it can be hard to get consensus, the best tool we've found for generating that among lots of, a collective of different people is through voting. In a past life, I worked on federal campaigns, so I have knocked on doors during dinner time. I have made hundreds of calls in an evening. I have sent massive amounts of texts trying to control, maybe even harass people into showing up at the polls. Still, in 2024, which is one of the highest turnouts in a presidential election we've had in decades, 33% of eligible voters didn't show up to the polls at all. So I can sympathize with the funds who have to deal with that annoyance, have to deal with that feeling of harassing people, the awkwardness of doing that. It's not easy, but it's really important work. And the participation of retail shareholders in these votes, proxy fund votes, is bad in the inverse direction compared to our broader democracy at about 30%. So it's clear that there's a problem here. It's clear that it needs a solution. We've got to work towards something. But I also think if we want to work towards the right thing, we have to identify the right problem. And so the proxy requirements, the thresholds set forth in the statute, the challenges of outreach, that's a process problem. The issue we need to be solving for is shareholder engagement. We want more shareholders participating. That should be the goal. And so there are, some indicators that shareholders are very interested in doing this in other parts of the marketplace. With regard to operating companies, obviously over the last decade or two, attention on the ESG components of voting your shares and directing company efforts has been hugely popular, has driven a lot of participation that perhaps didn't exist before. And so there's clearly a desire, and there's clearly a way that that shareholders can be educated to participate in these really important processes. And if we adopt the wrong policies, we risk undermining the really important role that investor oversight plays in holding management accountable, in oversight of leadership, and making sure that all those big decisions that are required to be voted on under the 40 Act are made in the best interests of the shareholders. Now, to be clear, there are good policies that are available to us, and other folks have mentioned them as well. I know we'll talk about this more later, but the retail voting program from the Exxon No Action Letter, I think that demonstrates a template of a potential good outcome. Now, I think that proposal is incomplete, and I think it was executed in the wrong way. However, broadened to allow people to assign their votes to more than just management, perhaps to a trusted advisor, perhaps to a public interest group, may sort of make it easier for folks to participate, not have to go through all of the paperwork and make these individual decisions, but still feel that their vote is accurately and fairly represented in all of these proceedings. There's also a lot of new technology available. There are new channels of outreach, especially through social media, maybe not Reddit, that can reach people where they're at. Again, working on elections, I have no doubt that it is harder and harder to get people on a landline, if not impossible. People don't like to answer their mobile phones. They don't like to get calls in that way. They don't like to receive texts. There are real challenges to actually getting in touch with people. So we need to reassess how we're performing that outreach and making sure we're using the channels where we can actually reach people. Overall, in addition to that, the outreach, there are also new technologies that make it easier to navigate and understand and perform these votes in a consolidated manner, perhaps through just one dashboard, where an individual investor can see all of the shares, whether in funds or in single stock holdings, where they need to participate and vote. That portal can assign those votes, can make it easier to understand and actually perform the votes, one singular place. So they're not receiving outreach from so many different participants, but have this one aggregated, easy to navigate place to perform this really important oversight function. All in all, we need to avoid a situation where we make abstention consent. I don't think that's good for the capital markets. I don't think it's good for the funds. And it's certainly not good for investors. And the issues that require these majority votes under the 40 Act are really significant and important. And so they are places where we really do want investors to be participating and to understand why it's important for them to participate. This also comes in the context of a lot of other changes to the ability of shareholders to oversee and participate in monitoring and holding management accountable, both in the public markets with operating companies and in funds. We have seen the development of new venues for corporate incorporation, and a lot of the attraction to those venues is more limited shareholder rights. We have seen, efforts from this agency as well to sort of tweak or even reduce disclosure to investors, really important information that they rely on to make sound decisions with their hard-earned money. There is an effort to overturn, decades of precedent with regard to allowing for mandatory arbitration agreements in corporate governance documents. And there has been a shift away from using the Administrative Procedures Act formal rulemaking process to meaningfully reach out to and receive input from the public, to articulate how the SEC has the authority and its reasoning for adopting certain policies, and to perform really, really important and intense cost-benefit analysis that are required under APA rulemakings and don't happen when staff guidance or no action letters come out. If we take all these as a whole, if we're not careful about what we do in every one of these places, including with regard to proxy fund voting, we really risk destroying shareholder democracy by erosion. And intentional or not, we may turn shareholder primacy into management dictatorships, benevolent or not. Robinhood, I was listening to a podcast actually coming in this morning, and Robinhood has announced that they're going to do a fund of their own venture capital investments. And so another thing to consider is that funds are getting more complex, and they're having more exotic products included in them. And so we really need to think about the intense level of oversight that some of these more exotic products and more risky products require of fund management. We're seeing private credit funds and other private investments that typically would not have been broadly available to retail investors, only accredited investors, coming into the market in wrappers that do allow access to retail investors. Obviously, the emergence of crypto assets is something that a lot of funds are interested in, and we're probably going to see the need for careful oversight of those kinds of funds. And so that changing landscape just underlies the importance of making sure we get this policy right and make sure investors' interests are represented throughout these processes. The SEC's mandate is investor protection, fair, orderly, and efficient markets, and capital formation. If we start with investor protection, always fair, orderly, and efficient markets will follow, and capital formation will follow. So all of this conversation needs to be centered on the interests of investors, investor engagement, and how we better reach and facilitate participation in this really important process. The other thing that this encourages and gets us is management and oversight by the wisdom of the crowd, in the same way that in the capital markets, efficient price discovery is governed by that broad sentiment all being collected into one shared set of information. So it may sound daunting to take on this task, of taking shareholders from extremely annoyed to extremely participating. But I would say that the fund industry is actually uniquely positioned to achieve this. They have changed investor behavior in the past. In the 80s, mutual fund ownership was about 1%. In the early 2000s, ETF ownership was similarly around 1%. In 2025, those numbers for mutual funds changed to, I think, 57%. Paul, I'm doing this off the top of my head here, something close to that, 57%, and ETFs about 14%. So we went from a world of defined benefit plans to defined contribution plans. We went from a world where people were making their own diversified single stock portfolios to relying on these new products and innovations offered by the fund industry to do that low-cost diversification for them. That's an enormous change in investor behavior, and it comes from enormous efforts on behalf of, from the investment fund industry. So I am optimistic that if we approach this correctly, and if we put the same effort into voter engagement and voter outreach that was successful in growing this industry so quickly, that we can get similar success from those efforts.
Good. Thank you, Corey, for your perspective. I'd like to get the panel's reaction to what Corey was saying. And, you know, we started out with Robert, who I think tried to frame an argument that there's a difference between being a shareholder of a public company and a mutual fund. And I think you heard from Adam and Teresa that investors in funds don't view themselves strictly as owners. They view themselves as acquiring the services of an investment manager who they put confidence in to manage their assets, keep them safe, and generate good returns. And, you know, they're not worried about voting, as you heard. But, Corey, you're talking about we got to preserve shareholder democracy. And to me, the fundamental question is whether or not the whole shareholder governance model that's kind of reflected in the 40 Act makes any sense today. And, you know, you have a framework today that, and this is different, again, than the public company structure. You have independent directors that are required on fund boards who have fiduciary obligations. They're making judgments about, do these fundamental policies make sense? Should we change from a diversified fund to a non-diversified fund? And, you know, they're making those judgments. And as you've heard, when these issues go out to shareholders, they're not voting against those. I mean, they actually invested in Hennessy and Invesco because they have confidence in the management companies and those boards of directors on their funds, who, again, a majority are independent, making these judgments. So I guess my question, and I'd be interested in the rest of the panelists to react, is, and I think you make some valid points about the areas where maybe shareholders should still be involved in the process. But I think the issue here is, are there areas where we can take shareholders out of the process and be more efficient, but not undermine investor protection? So you guys heard what Corey said. Any
Sure.
reactions?
So, Paul, your points are very well made, and Corey, I actually there's a lot in what you said that I agree with, and I appreciate your comments. I think improving shareholder engagement is something that is excellent for the industry across multiple fronts. If there is a way to get better feedback from investors as to what they want to see their funds do, we would be nothing but welcoming of that. But I think in reality, proxy voting is just not one of those channels. And I think it's interesting because, Corey, you mentioned ESG, you mentioned putting private markets into these more complicated fund structures, including crypto. And then you noted how the industry has had such success in changing investor behavior. They do that by voting with their feet. And I think that's an important part to keep in mind here, which is that the rise of first mutual funds and then the more recent strength and flows into ETFs. You've seen it by if I'm an investor that wants to see my fund do a certain thing, I want my fund to be more ESG tilted. I'm going to go and invest in an ESG fund. I'm not going to try to influence the management of the fund that I'm already in via the proxy voting process. Also, what's interesting about that, and it's something to think about when we kind of take a step back and look at where and when and why you have to get a shareholder vote in the first place, is that interestingly, I could put ESG as a focus or take away ESG as a focus in my fund without a shareholder vote. I could gain exposure to crypto assets without a shareholder vote. That's how doing something like a strategy change, or in the case of a passive fund, an index change. These are things which typically require, it's different across the board, but for the most part, investment objectives are not fundamental investment policies that are subject to a shareholder vote. We rely on that bedrock principle of the 40 Act, which is the independent board of trustees that, again, operating companies don't have. That, Paul, to your very, very excellent point, step in and advocate on behalf of shareholders. And so I think that while, again, new technologies having a better opportunity to reach the shareholders where they are, I love this. I think it's great. I think it also, unfortunately, tends to come with it new ways in which people are getting scammed and then become also appropriately skeptical when someone does reach out to them. But I think ultimately the intent from my perspective is have the shareholder experience match the shareholder objective. I invested in this fund. I wanted to have this experience, and that experience generally is not I want to dictate or control the way that the fund operates, the way that maybe as a shareholder in an operating company, you might have more of a feeling of, I care about this company and I want this company to do X, Y, or Z.
Yeah, if I can just add a couple points, and I agree, Adam and Paul, with your remarks, and Corey, I do agree with a lot of what you said, and in particular the important work that the staff does. So when the 1940 Act was written, the people who drafted the act, they considered kind of this question of what's the appropriate role of shareholders, and they made a conscious decision that unlike, say, operating companies, funds do not require annual meetings, and instead, and so they didn't see that as the way of policing management. It's not that they didn't think there were potential conflicts between management and shareholders. They put in a lot of substantive restrictions, things like restrictions on joint transactions and affiliated transactions, but they looked primarily to the board as the oversight mechanism over management. And unusual for that time, they set a minimum threshold for a percentage of independent directors, and that threshold has effectively been raised over time through SEC action. But even in 1940, kind of people understood that shareholder engagement was not the way to kind of direct management of the fund. Now, that's not to say that there aren't important matters that shareholders should weigh in on. So, yeah, if I'm voting with my feet, I choose Hennessy or Invesco because I want them to manage my money, and then they're getting bought out by some other entity. Yes, shareholders should have a right to vote on that acquisition. Similarly, if the fees, my advisory fees, are going to be raised, shareholders should have a right to vote on that. But the statute itself, I think, is part of the framework here. And I'll just say, from my perspective as a practitioner in this area, At the same time, it's become harder and harder to get shareholder approval for proxy solicitations. I mean, the quality and expertise of fund boards really has been elevated in the last few decades. Fund directors take their roles extremely seriously. They are not kind of rubber stamps for management by any means, and they work very hard to understand the complex investment strategies that you referred to.
So we are a small public company, and so I have a very, very close relationship with many of the investors in the public company. When a public company shareholder is dissatisfied, they engage. They call me right away. They call us right away. When a fund shareholder is unhappy, they redeem. There is another layer here that we're not talking about, and that is the portfolio managers or the investment objectives of the actual fund. That's what most fund shareholders care about. Are you doing what you say you're going to do in my prospectus for the money that I give you, for the fee that I give you? A lot of the feedback we get is, I pay you a fee. Why do I have to vote? You're supposed to be taking care of my things. And so those are fundamentally different relationships, in my opinion, and I do this for every day. When I speak with a shareholder of the Hennessy Advisors public company, they want to talk to me about strategy and what we're doing, and hey, your last 10Q or your last 10K, and you said this in the press release. When I speak with a fund shareholder, it's why is performance down? What the heck are those guys doing? It's not, even when we're in proxy, it's not even about the proxy, it's about the vote. So even when you explain what's going on in the proxy, they're still saying they don't want to vote. I've actually had the feedback, sure, I'll vote, then I'm redeeming. And I've actually had to say, please vote, even if you're going to redeem, so we can get to quorum. That's uncomfortable. And so I think that applying public company proxy mechanics to what is really heavy retail mutual funds produces structural quorum failure. But I do, like 99% of what you're saying, Corey, totally resonates with me because I speak with these people every day, and they want to be engaged on what they want to be engaged on. And fund shareholders want to talk about their portfolio. That's all they want to talk about. And I think that RVP, I do think that's a way for us to engage and start education. I do. But I think it's going to take so long that in between we've got to do something that helps us bridge this plumbing-wise. We have to get the mechanics better. So.
Let me chime in for just a second. I'm going to play academic. First of all, there's a very high probability that Corey and I vote for the same politicians.
Just because we're from California, you don't have to start it.
And you do. So last week,
Nonpartisan organization.
okay. Last week, my class at USC was actually on proxy voting, both corporate and investment products. As we were discussing, I realized something, and this is, I said, before preparing for this class, how many of you knew that Google had a board of directors? Everybody's hand goes up. And I said, before preparing for this class, how many of you knew that Fidelity's stock fund had a board? 0. And that was that's one of the benefits for me as teaching. Sometimes I realize, wait a minute, I'm too close to this. So, and these are all, they're either third-year JD students who either own funds or will own funds. And I also have LLM students who are already attorneys in other jurisdictions. So what we're asking for, if we started with a whiteboard, we're asking investors to vote on things that they didn't even know existed. So why wouldn't they be surprised when they get this in the mail? It's like, why? I didn't even know this thing had a board. So anyway, just that, like I said, we probably vote, in a similar way, but I would come out differently. I think just people's life experience, they know that politicians get a vote, and they know that IBM has a board, but they wouldn't know or expect that ETFs and mutual funds have a board. So it seems strange to them to get requests to vote on these things.
So a couple things. One, IAC members, if you want to put your card up, if you have any questions for the panel, we have about 20 minutes left. We're not going to get too many questions in, but I wanted to ask one. I think, Paul, could you just clarify? I think you gave us some very big numbers as to who is paying for the proxy. Is this coming out of the management fees? Is this coming out of the operating company? Is it coming out of the investor's pocket? Who's paying it, and what's causing all these costs? Where's the value chain here? Another way to look at sometimes your problems is to try to get the costs down.
Yeah, who is paying? I mean, I think it varies depending on the nature of the proposal, but I mean, certain proposals, for example, if a number of directors have retired and you've gone below this kind of statutory 2/3 elected directors, I think the fund would normally pay for that. Other kinds of proposals for, like, the advisor wants to merge with another advisor, I think it's normally understood the advisor would pay for that. Kind of where the costs come from, I think some of our white paper kind of gets into that, but I think it's the combination of having to retain solicitors, other service providers, having to do multiple rounds of solicitation. It's not the proxy statement itself, which does bear a certain amount of cost, but it's just all the multiple rounds of outreach. And I don't know, Adam or Terry, since you've kind of had to review the expenses of your recent campaigns.
Terry was quick to blame the lawyers, so I'll take the blame on that too. But I do think that it is given the nature of the outreach and the extensiveness of the outreach, it is the cost of solicitation, and it is manning a call bank with people who are, pressing buttons, dialing people, talking to people. Again, as I mentioned before, with our QQQ proxy, we estimated that we had about 5 million shareholders, so getting a hold of some to all of them, maybe, a majority of the shares outstanding, requires a lot of mailing, a lot of thought, a lot of consulting, a lot of, and again, just a lot of boots on the ground, people dialing phones.
I would just add, I mean, even where the cost is kind of being paid for by the manager, it's not like that doesn't have an impact to shareholders, because every dollar spent on proxy solicitation is $1 that the manager can't invest in improving technology or increasing returns or other important initiatives.
So in our case, we were doing an acquisition, and so of course we were paying for it, and the advisor was paying for it, but we're a public company. So it affected when we couldn't do the deal. Instead of being able to capitalize that money, bring in a really good product, have a lot of really good goodwill with, bringing in a really nice portfolio manager, a good product, a product we really believed in. We had to shut it down, take that on a hit as our earnings, which affects our public company shareholders and morale. And the whole process is just, it just really kind of was, and that's technical. But, I wrote it down. But someone's paying. And then if you're a public company, then, the public shareholders are paying, right? So that's that.
Thank you for clarifying that. Amy, try to get her tent up. It fell down. I think it fell down, not that she
Sorry.
wasn't interested in the question.
My tent is
Go ahead,
tired.
Amy.
Thank you. This has been really helpful. Thank you for your time and engagement on this topic, and thanks to my fellow IAC members for arranging for it. My question is not geared towards any singular opinion, so I hope no one really takes it that way. But we've talked a lot about the costs. Paul, in particular, has really given us some great data on the costs. And I get asked an awful lot about stock proxy votes and how do we calculate ROI. So I'm just going to ask Terry and Adam, is there an ROI? Is there a benefit to the fund companies? Are these votes net positive long-term shareholder value to you all? Do you see any positive gains? And then back to Paul also, to see if ICI looked at that.
So for us, when we do an acquisition, of course, because it's accretive and everybody, we never do an acquisition unless it's good for everyone. For our shareholders of the public company, for the shareholders of our funds, for the shareholders of the fund we're acquiring, and for the owners of the company that we're paying for the fund for. And so the ROI for us is building our business, and it's immediate. I do believe that there's a kind of it's not maybe a dollar ROI for when you're getting new directors and doing some fundamental changes, lowering fees, changing a corporate structure. Those are important long-term ROI for the shareholders that you're representing.
I would add to that. So it depends on what you're proxying for. If I get a call this afternoon that half the board is retiring, that's just the nature of the beast. That I wouldn't necessarily say there's going to be a huge ROI to Invesco by proxying shareholders to get the mandatory independent board in place. But I would say that the majority of things outside of that realm, we proxy. Let's say it's a fund merger. Let's say I would go back to the kind of the straw man of the diversified, non-diversified thing. We change and modify our funds because we think that the funds will ultimately be better in the long run. That is a shareholder benefit. But also they become more attractive to shareholders as a result. It is a viability thing. If we have a fund that has been subscale for a long time, it is up for rationalization. It may close, or we might be able to find a good merger candidate for it within our complex. If we merge and we need to seek a shareholder vote for that, the hope is that the merged fund will then ultimately grow and have scale and then grow from that point forward. So it's definitely, there's not a good methodology to it. We won't be able to say this will equal that, but it's part of our just overall commitment to making the funds as good as possible, which ultimately is good for us too from a bottom line.
I guess I should clarify. I recognize that some of these are business decisions that, ultimately management of the funds would like to be able to make. Is there any value in either the transparency, the disclosure, the feedback from, it doesn't sound like you're getting a lot of feedback. I'm just trying to understand if there's something that we're missing if we ultimately make a recommendation on this topic.
No.
Yeah.
Can I offer a perspective?
Yeah, go
on
ahead,
that?
Corey. I thought you would have a good.
So I'd start out by saying, democracy is a terribly inefficient system. It's been called, the worst system except for every other system. So no doubt, this can be an inefficient and challenging process. We've talked a little bit about the difference between operating companies and funds and the ways that they're held accountable. And I would say that, there was a time when there was a lot more trust in public companies to just, you'd set it and forget it and trust that they wanted to make money, so they were going to make you money. And I think over time, a lot of public companies tarnished their reputation there in a way that the fund industry has absolutely not. And so when we talk about sort of the current reality, I think it's worth, especially given that, when votes are held, most shareholders vote with management, that may actually be a sign of the system working, that the proposals that come out are in the best interest of investors because you're going to put all that effort into getting a quorum. You want things that are going to pass. And so I think there's value there that is beyond just maximizing potential fund profits. Some of these things are costly but have long-term benefits. And I think there is no guarantee that with a lot of these efforts, those savings, that will be 100% returned to investors. So I think it's worth considering that that may not really change anything. Appreciate that there's not good data on it, but
Yeah, I guess the only thing I'd add is, and I think Adam and Terry alluded to this. There are certainly when a fund decides to go ahead with a proxy on some kind of fundamental policy change, be it diversified to non-diversified or some other kind of change, they do the costs of that proxy solicitation are part of that analysis. There are some number of cases where funds will postpone decisions or maybe not decide not to make decisions or changes that are in the interests of shareholders just because there is that cost, and along with that cost, there is uncertainty. And I alluded to the proxy votes on changing from diversified to non-diversified, which failed because even with multiple adjournments, they couldn't get to quorum, and that and business people don't like uncertainty. So I think there are a number of potentially valuable changes to shareholders that just get shelved because managers are deterred by the proxy costs.
Thank you all. Andrea had the question, and then Jim. We are going to run short on time probably at the end of those two questions. We need the time for Andrew and for others to do the time. George, looks like you got the third and final question maybe.
So mine should be quick, at least I hope so. Thank you all for your remarks today, very educational, appreciate it. In the ICI white paper, they threw out a coupling a lower quorum requirement such as 33 1/3 with a higher affirmative vote requirement such as 75%. I can hear you, many of you say that the existing quorum requirement is unworkable, but I didn't hear concrete recommendations as to whether you would support what is being proposed here by ICI. Corey, I didn't hear you remark on that at all, but I would like to know if you do have opinions on that particular part of the proposal, and this is open to everyone.
I mean, I think that would be great, but that's a long path, and I still think some of the plumbing issues would be better. I do think the 33 1/3 and the higher positive response would be fantastic, but that's a really long road. And if we could apply technology to some of this other stuff, I think, and go for and try to do that too. Like I said, it's got to be this path. That might solve a lot of it by the time we get there. But I don't think any one of these is a magic wand. It's got to be a lot of reform that puts the shareholder first. That's what I really think.
I think given, the data we've heard about how the shareholders that do participate vote, how they vote, lowering the quorum requirement and raising the threshold really just dilutes shareholder participation in the oversight in the exact same way, right? If 92% of people are voting with management and we lower the quorum to 33 1/3 but raise the voting threshold, there's not going to be a challenge to get the same 92%, it seems. So with the current level of education and engagement with retail investors, I don't think lowering the quorum and raising voting thresholds does anything that doesn't undermine shareholder oversight in the exact same way.
I guess I would say that when I was asked to be on this panel, I said I'm very good at the problem statement. I don't necessarily have the best grasp on the solutions. But I think that the answer is that it maybe what Tara is getting at, it's a good piece, but there probably will need to be a mosaic of solutions in order to really, while also addressing some of the concerns that Corey's raised on this point.
Yeah, I mean, the one thing I'll add, so, I mean, certainly, I think the SEC could adopt this kind of third way, higher quorum, lower quorum, higher affirmative vote requirement through rulemaking. To Corey's point about the intelligence and creativity of the SEC staff, I would not rule out that couldn't be done through no action relief or perhaps exemptive applications. So those are kind of quicker paths that the SEC should explore.
Yeah, my follow-up is on the exact same point. I was on the same bullet point, the first of the 6 bullet points that Andrew was focused on, and your last comment, Paul, which was similar to I think what you said earlier in your prepared remarks. I guess I'm just confused about how the SEC could do this without congressional authorization, right? I mean, to me, the statutes 5067 is in the statute. So I don't understand, particularly given, the current court and the current attitude towards administrative agency adventurism outside statutory text. I don't see how the SEC could do that. I may be wrong.
Yeah, I mean, I won't go into a detailed legal analysis. I mean, one of the virtues of the 40 Act, so I mentioned it's very restrictive in a lot of ways. And in some ways, it's inspired more by the public utility regulation than the ordinary public company regulation. But there is a safety valve. There's a very broad exemptive authority from pretty much any provision of the 40 Act that is delegated to the commission. So, yeah, I mean, the commission would have to decide whether its exemptive authority would reach to this kind of third way alternative of quorum.
Hey, Paul, could you talk about the Exxon no action letter, and how would you view that working in the fund context?
Yeah, very quickly. So Exxon, yeah, the SEC issued relief to create for Exxon and other companies to be able to create a standing voting instructions program where your shares are going to be voted consistently with the recommendations of the board. Now, there's a nuance to that. There's actually three options. There's one where your shares are voted with the board all the time, one where you don't give them the discretion to vote, and then kind of an intermediate one where you vote in line with the board recommendations, except on things like contested election of directors and mergers. So, I mean, there's no reason under the proxy rules why a similar relief can't be relied upon for funds. I mean, maybe in that intermediate category, you add things like advisory contract renewals, but other kinds of routine votes like a non-contested election of directors. Yeah, the idea is when you buy your shares, you get an opportunity to opt into these standing voting instructions. It's understood you can opt out at any time. There's a periodic reminder of the fact that you've opted in and have the right to opt out. But it can be a very effective way of allowing shareholders to have their votes heard without having to vote in every single election. So we submitted a draft no action request to the SEC where they're considering it. We're kind of hopeful it will go forward.
Yeah, I'll just add, sorry, and apology. I was just going to add to that this goes back to my mosaic point. I'm not sure there's a silver bullet on this. The last thing I want to do is do a proxy to get people to say what they want their future proxies to be. How many people, when they get their TSR, are going to scan the QR code to enter their voting instructions. But every little bit would help a little bit. Extending no action relief to index funds that can move with their index into and out of diversification as compared to, or other places where you can do it more easily. I think all of these things, each little piece, every little bit would have a significant impact, in my view, a positive, significant impact on funds and their shareholders.
Thank you, Adam. George, quick
Can I just
last
add my
question?
voice?
Oh, good.
Not a lawyer, but I have heard compelling legal arguments that ExxonMobil no action is not consistent with either regulation or statute. And so I think with regard to the import of this, and also just for consistencies and dependabilities, let's say, to reduce business risk and uncertainty, the APA process is the right process to be doing these things through. As we all know, staff guidance doesn't hold the force of law. These no action letters do not hold the force of law. I don't think the exemptive relief provisions are sort of the right way to approach these really important fundamental issues. So again, I think the APA is really important here and should be the process for whatever decisions are made.
Yeah, just a quick question. So everything that the panel has said in terms of this problem has been quite illuminating and reasonable, and so but this doesn't strike me as a new problem. So why haven't it been solved before? This isn't something that arose in the past couple of years. If I had to bet, it's probably been the problem for decades. So why are we here in 2026?
So I'll answer that in two parts. First, it has been a problem for quite some time. I think that Paul even mentioned that this has been a topic that has come up a few times. But I think that it has been greatly accelerated with technology, actually. And while technology could potentially pave a way to a solution, right now truthfully, I don't want to say, oh, there was a time when people would answer their phones and be willing to talk to someone on the other side about, something important regarding their investment. That time is definitely not now. The ability and with the rise of malicious scamming, people are more than ever suspicious of any sort of outreach. You've got to be either trying to sell me something or take something from me, which is just an unfortunate reality of, I think, where we are currently.
Hey, I want to thank our panelists, Adam, Terry, Corey, Paul, and Robert. You guys have left us with a lot to think about and how to protect investors, but also how to maybe modernize the proxy system and make it better. We certainly don't want to be annoying our investors. We really want their input on important matters. So Investment Advisory Committee will take it from here into, can we pull together a recommendation for a future meeting? And with that, I'll give it back to Brian.
Thank you very much. That concludes our question and answer session for the second panel. Thank you to our moderators and to our panelists for their insightful contributions and the spirited discussion that we had. Next, we're going to discuss a potential recommendation of the Market Structure Subcommittee regarding the tokenization of equity securities. That's going to be led by John Gulliver and Andrew Park.
Thanks, Brian. So I'm going to start us by just briefly summarizing some of the high-level points addressed in our recommendation. I think Andrew then is going to dig a little bit deeper into some of the specifics and perhaps how they relate a little bit to the comments earlier from Commissioner Peirce. And then we're going to open it up to the room for comments. So please feel free to let us know if you're supporting, why you're supporting, if you're not supporting, why you're not supporting, or if you're abstaining the same. We want to have as much of a discussion as possible. And then obviously we will vote. So to begin, I mean, part of what we're trying to do here is explain what are we talking about, right? Because there's a lot, the word tokenization gets thrown around a lot these days, and we want to be very specific in our focus and in how we define the issues. So to put it simply, today the ownership and trading of equity securities is managed through centralized databases controlled by brokers, the DTC, and the National Securities Clearing Corporation. This is what is commonly referred to as the plumbing of our equity markets, and it facilitates over 1.9 trillion in daily trading volume. And this is obviously a huge amount of volume. This is very important for how our equity markets function. The advent of blockchain technology presents for the first time the opportunity to tokenize equity securities. And what this means is the use of centralized databases would no longer be necessary for the ownership and trading of stocks. So our recommendation tries to do a few things. We try and provide some definitions, some clarity about what we're talking about. We discuss some of the potential benefits and the risks of tokenization, and we evaluate key policy issues and set forth a path for reform. Where we ultimately end up is, we are supportive of innovation, but we believe that reforms should be adopted that are necessary to facilitate the tokenization of equity securities and do not compromise certain fundamental investor protections. And there are three of those investor protections. Specifically, mandatory disclosures should provide investors with a clear understanding of their ownership rights for tokenized equities. The SEC, state, and/or FINRA regulation should maintain regulatory oversight of intermediaries for tokenized equity securities. The definition of intermediaries is not something that we address in this report, and that's something Andrew will get into a bit more, but it's a highly complex issue. And then also we support a requirement that the trading of tokenized equity securities should aim to ensure that all investors receive the best terms for their orders. Of course, that should be the goal. I mean, guaranteeing that is a different matter. And then in terms of what actual how these policy reforms can be achieved, what we support is a limited or narrow innovation exemption or rule-by-rule reform. But critically, either approach, in our view, needs to adhere to these three principles that I outlined, as well as include an opportunity for public comment and notice. Just as a final matter, and just to clarify, we really do stay high level in this recommendation. We believe the tokenization of equity securities is a highly complex issue, and it is at a very early stage at this point. And it is really not conducive to highly prescriptive recommendations from the IAC in our view. So that is why we sort of take this approach. So just to provide a bit more clarity on definitional on the definitions, which we think could be helpful. So the important thing to keep in mind about tokenized equity securities is that what we focus on here is consistent with the definition of a security. Therefore, the rules that currently apply to securities inherently and necessarily apply to the trading of tokenized equity securities. However, the technology underlying how tokenized equity securities can be issued and trading can introduce new issues and may function in a way that there needs to be exemptions and reforms to our current rules to enable tokenized equity securities to be issued and traded. So that's kind of setting the stage about what we're talking about. Tokenized equity securities, there are various types and different ways to tokenize equity securities. We don't go through the full taxonomy of all those different ways. But we do flag a few, distinct characteristics that we think are important because those characteristics can impact the appropriate, regulations and exemptions that should apply to their trading. So first, there is a distinction between tokenized equity securities that are native and issued directly on a blockchain as compared to wrapped tokenized equity securities, where the underlying equity security is custodied by a custodian and a token is issued representing an interest in that custody position. And then second, equity securities can be tokenized by the issuer themselves, or they could be tokenized by a third party unaffiliated with the issuers of such securities. And fundamentally, the policy issues may be different, right? Because you can imagine how a wrapped tokenized equity by a third party may present different issues with respect to shareholder voting, bankruptcy rights, and what the owner of that wrapped tokenized equity security, what their rights in fact are. So now I'll touch a little bit on the benefits of tokenization, and then I'll shift to the risks, and then I'll turn it over to Andrew. So in terms of the benefits, I think the one that everyone understands is very, very real and can really improve the functioning of the plumbing for the stock market is enhancing the efficiency of the settlement process. I think we all remember the GameStop event from 2021, and that was in large part related to our current T+1 settlement system, where there is a substantial delay between when someone purchases a stock and once that trade is actually fulfilled. That can result in a lot of risk residing at the broker-dealer. It can also pose risk at the DTC, and those risks can result in trading disruptions. They can and the tokenization can actually allow for instantaneous settlement, which reduces those risks from the system. So it can avoid perhaps unnecessary trade failures like has occurred in the past. Another potential benefit of tokenization is that it can enhance engagement between public companies and their shareholders, can facilitate more direct engagement because there will be the tokenized equity security allows the public company to have more direct insight into their investor base and can facilitate direct communication. It can also eliminate the need for intermediaries for certain corporate actions, including the payment of dividends and proxy voting, and that can reduce the costs of those actions for investors and for companies. And finally, the reduced need for intermediaries can also help facilitate a shift to 24/7 trading, which can enhance pricing efficiency, can enhance more timely capital allocation also. So with respect to the potential risks for tokenization, I think the biggest risk is the reality that the regulation of the trading in equity markets is presently very successful. Trading costs are very low, historically low, zero commissions for virtually all retail brokerages. Institutional trading costs in the United States are lower than they are anywhere else in the world. Post-2010 flash crash, a lot of reforms have been adopted by the SEC that has resulted in these market breakdowns and extreme price volatility becoming much less rare due to market structure problems. Investors also have a very good understanding of what their ownership rights are when they buy a security today through a registered broker-dealer. And shareholder engagement with public companies is strong in many ways. The largest asset managers are providing their retail and institutional investor clients with new opportunities for how to directly vote their own shares. And in our view, a lot of the reason our capital markets function well in these ways is because of strong, effective federal and state securities laws. So the biggest risk, with respect to the tokenization of equity securities is that the reforms or grants of relief that would allow for this adoption could potentially limit these regulations that have been effective for so long. It's not necessary that that's the case, but it's a possibility, I think, that we want to be aware of, and that's why we recommend an approach that supports exemptions where appropriate, but also adheres to certain basic principles for the regulations that should remain. So I could go on a bit more, but I think that sort of covers us at the high level. So maybe with that, I'll turn it over to Andrew to get into the specifics a little bit more. Andrew?
Thank you, John. So as we had heard back in December on our panel, we had heard a number of times about how when there is the same activity, there should be the same regulation. And what we're also trying to think through in this recommendation is also what happens when you have a similar activity and a slightly different sort of a different application of that. And so what are some of those? John had outlined what those three are when it comes to the first being mandatory disclosures in order to make sure that investors are clear as to their ownership rights. And this is, of course, very important because if you recall, the IAC had held a panel back in September where we had looked at this from a different context. We had done a panel on foreign private issuers, and this issue had come up of what happens when there are ADRs in other jurisdictions where they use different structures, namely I'm talking about the variable interest entity, right, VIEs, where this whole notion of ownership is not entirely clear. Now, as John has mentioned, we don't want to have that issue here in the U.S. when it comes to this whole notion of a third party who is issuing a tokenized security. And so therefore, what we are calling for in mandatory disclosures is a very short and simple disclosure that makes it very clear what are the ownership rights, what sort of voting rights come with the shares, are you entitled to dividends? And then what happens in specific types of corporate actions, whether that be stock splits, M&A, spin-offs, or in the case of bankruptcy. Some other things that could also be very useful in this very short and simple disclosure is just understanding what is the nature of the tokenization's legal arrangement with other entities. Who are the identities of other parties in this tokenization arrangement? And then any sort of clarity on how exactly holders of these tokens can either redeem or transfer them, or whether there are any sort of restrictions that would preclude them from any sort of transfer. And so Commissioner Peirce this morning had asked a very good question about, how does the SEC's existing issuer disclosure interact with this? And then the good news is that, SEC EDGAR, in which we call for in our recommendation, is well suited to do this. But as we also heard from our panel this morning as well, too, there can also be other ways where we can look at how disclosure over the EDGAR system is done. And so as we're talking about this new blockchain technology, one other question comes up of, is there any way to get these sort of disclosures directly to investors in a more direct and quicker way? And this has come up because In another context, we have also seen questions come up when we talked about a recommendation back in June of 2023, when we talked about leverage ETFs, where we talked about, okay, it's one thing for the investors to take, to invest in riskier leverage assets. It's another thing if they do not understand what they were invested in. Could there be a just-in-time way to deliver that information so that they understand what they own? So just another consideration of, can the issuers provide this information more directly in another way, since we're talking about a lot of the benefits of this new technology. And so another major point is the fact in our recommendation, we are calling for all intermediaries to be subject to SEC, FINRA, and state oversight. And so to kind of reiterate what John has says, at this time, we are not weighing in on the exact definition of an intermediary, and we will defer to Congress to make that determination. But instead, what we want to do is focus on very core principles of what we don't think can be happening. And so one of them is that we outline in our recommendation is that there can be no fully anonymous trading. That is not the same as pseudonymous trading. What we mean by that is, right, and typically a broker-dealer, when there isn't different parties involved in the trade, they usually record the beneficial owner. And so if we start to allow trading where there is fully anonymous trading, then that presents a number of issues. So one of them being issues around voting, right? We just heard from the other panel about what happens when you can't reach your voters. Well, if you don't even know who they are, that poses a problem right there. And then also issues around know your customer and making sure that there is the proper safeguards there. Now, in saying that, we're not saying that the same legacy way of doing KYC needs to be done, where it can sometimes feel like a very manual process, one that can entail a lot of siloed, different types of, a repeated siloed process. But what we're saying is that that must still be done in this sort of arrangement. Another question that did come up from the commissioner was, how do we think about this in terms of broker-dealers? And so, there are many different issues that can arise from this. So I'll just kind of focus on one, is that, in the traditional way that we trade, you can see the fact that there are obviously rules around custody and record keeping. And so the difference, this is where, again, what's similar but slightly different, is that we can, in these circumstances, you have broker-dealers who are dealing with private keys. And so what happens in those kind of situations? It's a little bit interesting with this technology, because there are the ability versus in the traditional way of broker-dealer custody where, for example, I'll just name one, multi-party computation, where multiple parties can collectively do verification of private keys. And so I guess the best analogy there would be, when people talk about nuclear launch codes, for example, all right, it requires two keys to turn at the same time in order to activate that. And so similarly, that is something with this new technology that is of consideration. But whether that is for disclosure or whether that's for exams, this is not part of our recommendation, but just the different ways that we have tried to think about this recommendation here. And then finally, we say in our recommendation that tokenized equities must be subject to the same relevant protections as investors in traditional equities are as well. And so that would be things of execution of reports, for example, keeping the same minimum price increments, making sure that there is fair access, and then also order protection. And so with all of this, as John had mentioned, we can either look at this either through the SEC could look at this either through limited innovation exemptions or through a rule-by-rule review as to how relevant these different features are to, these inherent investor protections are to tokenized equities going forward. And so, above all, given the enormity of what we're talking about with these changes, it has been very good for us to have these, this panel that we had back in December. It was very good to have these roundtables where we heard from a lot of different market participants. But, one of the other kind of questions that has come up too is that, And a question that the commissioner also raised too is that, there are other many key questions that still need to be answered. And so another one was, what happens, should a third party require issuer consent in order to be able to issue an existing equity? And that's a very important question. And so this is also why, given the enormity of these changes, we are in our recommendation calling for a public comment period so that issuers can weigh in and mention and share their views of what they think about third parties being able to potentially tokenize their equities. And so with that, I will open it up for discussion.
Great. Why don't we turn to Rodney first?
Hey, I appreciate the SEC putting their location right next to the train station so I could get my comments in here before I run off to catch a train home. First of all, thank you to Andrew and John and everyone on the Market Structure Subcommittee for their hard work on this. It is an enormous possibility for the industry, an enormous change, and I think our voice is important to be heard. I am in support of the subcommittee's recommendation. I think because it strikes an appropriate balance between promoting innovation, but yet protecting strong investor and market protections. Markets function best when there is regulatory frameworks that provide firms with the flexibility to innovate while maintaining the protections against risks that could erode investor confidence and market integrity. Specifically with tokenization, I think that mandatory disclosures that explain investors' ownership rights are essential to inform decision-making and confidence in tokenized markets, at the same time subjecting intermediaries to comparable regulatory and oversight and applying best execution type protections to tokenized equity securities helps protect market integrity, resilience, and fair outcomes regardless of the technology. Finally, I agree that a time-limited innovation exemption would be helpful to help identify any additional regulatory gaps and inform future guidance and durable rulemaking. I'm going to have to step out. I've given my vote to Paul on it, but again, thank you guys for your work.
Thank you. Andrea, I think, and then Alvin.
Sure.
Do I have
you
that
wanna go
backwards?
first,
Alvin,
Alvin?
do you want to
I'll
go?
go super fast.
Yeah.
'Cause I actually have to run. Thanks,
Yep,
Andrew.
sure.
So super fast, I support the recommendation because one, John, your point about this being high level is conceptual. Secondly, because it does not adopt a blanket innovation exemption, it specifically has that language. I think otherwise, if it didn't have that language, I probably would be abstaining or voting against. I think with that, I feel comfortable voting for. Ryan, I have to leave, so I'd like to give my proxy for voting for support. Thank you.
Thank you, Alvin. Andrea.
So thank you, John, Andrew, and all the members of the Market Structure Subcommittee for pulling the recommendation together in record time since our last meeting, and for recognizing the importance that tokenization has in our evolving financial markets. I'd like to start by expressing my appreciation for the subcommittee's emphasis on investor safeguards and its recognition of the important role that state regulators have in the securities markets. I also appreciate the subcommittee's endorsement of notice and comment rulemaking as the SEC seeks to adapt its regulations to accommodate securities products and services that move on chain. That said, I will be abstaining from the vote on the recommendation today because while well-intentioned, I'm not sure how some of these recommendations would work mechanically in various contexts, and I think I would just need more time to work through these issues before I would feel comfortable voting. For example, one of the key principles outlined in the recommendation is for the SEC to adopt a new mandatory disclosure requirement for all issuers of tokenized equities. Disclosure is important, but the securities laws already require disclosure of material terms and risks as part of existing registration and exemption frameworks. To the extent a tokenized equity provides investors with exactly the same rights and privileges that the non-tokenized version provides, additional disclosure could be superfluous and could result in the imposition of unnecessary burdens and expense. To the extent a tokenized equity provides materially different rights and privileges than the non-tokenized version, an entirely new financial asset could be created that might require much more than a short-form disclosure document. Separate registration as a new security or perhaps a swap may be required. Commodities laws may apply in addition to securities laws. The January 28, 2026 tokenization guidance issued by Commission staff addressed several such scenarios, and it's not clear to me how the recommendation today fits into the regulatory constructs that were outlined by the staff. Lastly, although I will be abstaining from the vote, I wholeheartedly agree with the subcommittee's recommendation regarding the need for notice and comment rulemaking in this area. The subcommittee is right. Transparency and public input results in better policy making and promotes investor confidence. Once the market structure bills pass and tokenization and other digital asset policy issues ripen for SEC regulation, I would encourage the Commission to follow the IAC recommendation if it is adopted on notice and comment rulemaking. Thank you.
Great, thank you, Andrea. And I think Sergio was next, and then James? Is that right? Did I have that?
I want to echo the thanks to John Gulliver and Andrew Park for their hard work on this, as Andrea mentioned, in record time, or at least what I think is record time. I agree with the spirit of the recommendation and that we shouldn't adopt a blanket innovation exemption, and agree with several of Chairman Atkins and Commissioner Purse's comments in the past on seeking a narrower definition of the innovation exemption, and look forward to ongoing discussion and analysis to advance that. Additionally, I agree that at this stage of the technological development, a principle-based recommendation is more beneficial to investors and shareholders, especially because technologies are rapidly advancing, and that's an understatement, and better understanding of the tools being built to modernize a lot of what we talked about today, the plumbing. Lastly, given the recommendation statement that there are different approaches to tokenize securities, and what I continue to advocate for, which is interoperability across technology, and not having, let's say, 50 different chains or different infrastructure layers, creating additional burdens for issuers. In a deeper dive and public comments to further flesh out these issues, I do support vote in favor of the recommendation. Thanks.
Now me. Just wanted to echo what everyone else said. Just kudos to John and Andrew. This was very quickly done in the sense that we had our public discussion in December. I learned a lot there, and by February we had a workable document, and a lot of hard work and thought, and being able to be very responsive quickly was essential to making that happen. In thinking about this, and I'm still new here, this is my third meeting, the principles underlying what we are as an investor advisory committee sort of come to mind for me. And one of those is that we are an advisory, not a rulemaking body. So when we're considering these recommendations, I abstained the first two times. I hadn't been involved in the process, but having been on the periphery of this process, I think it's important to keep that in mind. We're not trying to necessarily all come to a consensus on every dot and dash in an agreement. We're not worried about what litigation's going to look like challenging this and trying to reconcile it with a statutory scheme necessarily. We're trying to put some guideposts in the ground, ask some good questions, stand up for some principles that we think the Commission ought to reflect upon as they engage in a course of action. And a lot of what we do is central to agenda formation. So it's not a full APA notice and comment process at all, but we're saying we think this is really important, and here are things to maybe keep in mind as you move forward. What I like about this document in particular is that it's broadly principled based. It's not granular, it's overarching. Many of the very well-considered questions Commissioner Peirce threw at us this morning, we didn't get to that level of detail. We didn't necessarily have that level of consensus. I mean, there were some people in the discussion who thought, well, this is going too far, too fast. Others like, no, this needs to go much further, faster. Necessarily, we sort of reach some sort of compromises as these sort of processes are going to do. But I think overarching principle-based decision-making for this committee is well within its ambit, and particularly appropriate for something that we've worked on relatively brief amount of time and is concerning a technology that is new and changing rapidly. I want to put 3 points out there that I think I want to emphasize about the document here and what we're doing today. One, I think what we are saying, whatever disagreements we have amongst ourselves, is that this is very important. It's a potentially transformative technology in how equity investing works. And we've seen this time and again where innovations change the way we do things every day. And this could be that transformative. And therefore, it's important to highlight this for this committee to the Commission. Secondly, some SEC action is necessary here to enable these technologies, given differences from traditional financial products and systems. There are debates about how much is necessary and what is or isn't necessary. But necessarily, because of the importance of this and because the existing system was set up with the old world in mind, the SEC has to do something here. And third, as I alluded to, this is changing rapidly. It's not at all clear what things may look like in 3 years or 5 years or 10 years. And so, that should give us some caution. And so I want to elucidate 3 principles that are my takeaways here that are the reasons why I'm ultimately going to support this document, despite some disagreements on sort of granular framing within the document. And that's that it proceeds. It's asking us to proceed expeditiously but cautiously, looking at a limited, not a blanket innovation exception. The need to get out there and get in front of this technology is important, but we don't want to blow a bunch of things away with unintended consequences for something we don't totally understand. And we think that's where the SEC should go. Second, it embraces notice and comment rulemaking. There are times where the SEC has to act before notice and comment rulemaking can be done, but particularly in an area that is transformative with major economic significance, operating without clear congressional guidance, notice and comment rulemaking is the way where our unelected, albeit somewhat accountable, administrative bodies are responsive to the body politic where Congress has clear authority here. And third, or C, the document is very clear about wanting to promote technological arbitrage, not regulatory arbitrage. And this is both between sort of the meta framing between traditional finance and these new technologies. We don't want to pick the winner or loser here, but also among competing technologies. I'm reminded of the format wars, back in my childhood with Betamax and VHS or 8-track and audio cassettes, and now it's been DVDs and streaming and everything else. We don't want to pick who the winners and losers are here, and we don't want the regulations to drive that decision. We want the technologies to drive the decisions. Technological innovation will hurt incumbent players. It always has and always will, but we want the technology, not the regulation, to be the driver. I think these 3 broader principles are consistent with where our chairman, Paul Atkins, and where Commissioner Peirce have been in their colloquy just last month. Chairman Atkins said an innovation exemption to facilitate limited trading of certain tokenized securities on novel platforms with an eye toward developing a long-term regulatory framework is where he was. And Commissioner Peirce said she wanted to talk for a minute about an innovation exemption which has inspired hopes and fears that both may need some moderation. It'd be an important step toward facilitating the integration of tokenized securities into our existing system, but would not change the entire financial system overnight. We're working incrementally now, as we've always done. And I think that this document is consistent with that vision and comports with it. So, I could get into some of the technicalities about the 3 other points that are focused on in the document, but I'm going to sort of avoid doing that now, particularly in the interest of time. I don't necessarily agree with 100% of them. I think some of the questions the Commissioner raised this morning are important and significant, but I applaud the work that's been done here by John and Andrew, and I think it's an important contribution from this committee. Thanks.
Okay. Do we have a motion?
I move approval of the recommendation.
Okay, please note that, as is our policy, if the recommendation is approved by the committee would be approving it in a substantially final form, with the chair and the vice chair of the Market Structure Subcommittee being authorized to make any final non-substantive changes to style and format and footnotes. A second.
Second.
Okay. All those in favor?
Aye.
Aye.
For the record, just want to note that Rodney Comagis also voted yes, and Alvin Velasquez voted yes. Nancy Lamond abstained. No.
Yes, I also abstain.
Okay. No, you said, okay. Did that get into the record that you're voting? I don't know if my microphone not have been on, so let me just say it again. We did receive a yes vote from Rodney Comagis, from Alvin Velasquez. Nancy Lamond abstained as well. Thank you very much to the subcommittee. Thank you for the work done by John and Andrew. Let me now move to our next segment, will be our brief reports from our subcommittees. Andrea, Investor's Owner.
It's been pretty quiet. There was preparation, obviously, for one of the sessions today. So that's really the only thing worth reporting on. Thank you, Mr. Chairman.
James or Amy? Amy for Investor's Purchaser?
I don't really have anything to report, Brian. It's been very quiet on our end.
Okay. Andrew, Market Structure?
Yep. Well, we've obviously been working on this recommendation, and other than that, it has been a pleasure to lead this subcommittee, and so we'll talk through very shortly about succession very soon.
Okay. Well, that marks the end of our subcommittee reports, working group reports, and formally concludes today's meeting. This is the final IAC meeting for a significant cohort of our members. It's my last meeting as chair. Paul Roy is vice chair. Colleen Honigsberg is secretary. James Andrews is chair of the Investors Purchasers Subcommittee. Christine Lazaro, chair of the Disclosure Subcommittee. Andrew Park, chair of Market Structure. And Gina Gale Fletcher and David Royney as members of the committee. I'd like to thank the IAC's Executive Committee and the other members of the IAC for all of their efforts and hard work. It's been my pleasure to serve as chair and to have worked with all of you. I'd also like to thank and announce the new IAC's officers-elect. They were elected during our executive session this afternoon. Our new chair, George Georgiev, our vice chair, Andrea Seit, our secretary, Amy McGarity, and our assistant secretary, John Gulliver. As always, I'd like to recognize and thank our staff at the SEC, Mark Sharma, Adam Anasich, Adam Moore, Charles Kwok, and the entire supporting staff for their ongoing commitment and for their diligence in supporting us and our IAC proceedings. Finally, I'd also like to thank our most recent director of the Office of the IAC, Christina Martin-Fervita, who's been with us, who had been with us as the head of that office during much of my term on the IAC. And with that, our meeting has come to a close. Thank you very much.